Hello, in this video I'm going to give you a walkthrough to how does a venture investor here at Headline look at the financial performance of a company in Deepdive? What are the metrics that we look at? How do we kind of make sense of all of this? And when I get a new dashboard sent to me, I will first just sense check from a high level. What are the kind of revenue numbers, cost of goods sold? What are the values in the P&L? And do those align with the revenue cohorts and kind of the other metrics here as well, just to make sure that the numbers I actually look at here are coherent. And from there, we'll always want to evaluate how are these cohorts driving the top line growth of a business. In a perfect world, we can actually see this type of behavior where this business is adding new cohorts of a similar size every single month over time and growing up and to the right at a very kind of consistent and repeatable rate from both a revenue and a customer perspective, and not seeing like a single cohort driving the majority of the overall growth of the business, given that that would drive certain level of customer concentration. The second piece that I want to look at is ultimately how much new revenue is this business acquiring every single month, and are there any outlier months in terms of new revenue or churn? Here, is there anything that sticks out? In this case, it's kind of fairly consistent over time. There's no kind of major outliers, but then just eliminating the noise from all the other kind of values here, just looking at how much new revenue is this business acquiring every single month. And in a perfect world, you'll see this type of behavior where every single month, in a sense, is the business's best month ever, with the business acquiring more new revenue as it ages over time, ultimately enabling it to grow at an accelerated pace. From there, we'll want to look at how does this revenue, how do these customers that the business acquires every month retain over time? And the number one thing that we ultimately look for here is what we call asymptotic retention behavior. When a new cohort, a new month of worth of customers comes in, and we have 100% of customers, and it's totally fine if there's a certain level of churn within these first couple of life months of a cohort being active. We do want to see these cohorts starting to flatline, or what we call asymptote, at some level though. And what we can see here is that kind of after about kind of the month 8 mark, these curves tend to flatline around, call it the 30-35% range, which lets us kind of hypothesize that when this business acquires 100% of new customers in a given month, 35 of those will continue to pay and use the product every single month into the long term. Or when we look at this from a revenue perspective, you have $100 of new revenue come in a given month. There's a certain level of churn initially, but then this flatlines around kind of the 45% mark. Again, letting us extrapolate that when this business acquires $100 new of revenue, 45 of those dollars will come in like an annuity every single month into the long term. And going back to this cohort layer analogy here, it really means that this business acquires a new cohort. There's a certain level of churn in the first couple of months, but after that churn has kicked in, there's no more churn after this cohort stuck around for 6-7 months and really acts as like a solid foundation for the future growth of the company, not as quicksand. If there would be continued churn within these cohorts over time, you would see these layers getting thinner and thinner and ultimately becoming increasingly harder for the business to grow over time. After looking at the retention dynamics, I will want to take a closer look at the unit economics and ultimately looking at how much is a business investing into acquiring new customers or growing the business, which is ultimately the sales and marketing spend of a business, versus how much value is the business getting from that investment in terms of what is the lifetime value, the customer lifetime value that the business gets for every customer that it does acquire. And for that, the way that we think about customer lifetime value is looking at what is the cumulative gross profit that every single customer is generating for the business over time. And you can see that in this demo data set, customers come in, spend about $100 in the first month in gross profit and continue to grow as customers retain over time. And within kind of the first year, the business can expect to generate $650 for every customer that it does acquire, and it will continue to grow from there, given that we have this flatlining retention dynamic. I will then want to compare that versus the customer acquisition cost. And this is relatively spiky in this demo set, but it's give or take around, call it the $400 mark. And it's staying relatively stable. So for this business, I can see that it costs the business around $400 every single month to acquire a new customer. And it seems to be staying, even though spiky, relatively stable as it's spending on this over time. and then want to compare what is this cumulative gross profit in relation on a month-to-month basis versus the cost of acquiring a customer in a given month. And we do this in this cumulative gross profit over CAC chart, or we at Headline like to call it the core ratio, as it really depicts what is the return on investment of a business's growth spend. How much does it cost the business to acquire a customer, and how fast does it recoup that cost of acquiring a customer in terms of the gross profit they generate from it? And in this case, you can see that when a cohort first comes in, it takes about kind of 7 months to 8 months on average for the business to pay back this customer acquisition cost. The cumulative gross profit equals the customer acquisition cost. It's this 1 mark, and then continues to grow from there as these customers retain and keep spending with the business over time. And in a perfect world, we see businesses being able to pay back their customer acquisition cost within 12 months and get to 3x this customer LTV within 3 years. Another thing that I will want to check is that how are cohorts trending over time on this metric? And you can either eyeball this by looking at how are the longest light blue cohorts trending versus the more recent darker or the latest orange cohorts, or even look at the side cuts, which tells me where is the customer lifetime value versus CAC on a certain business after the first month across all cohorts. So we basically map out all the cohorts here where their LTV to CAC was after being around for 1 month, or after 6 months, or after a year. And I can see that this is staying relatively stable as this business is acquiring new cohorts over time. So this LTV to CAC dynamic is ultimately staying stable for this company. Lastly, I will want to see how does this convert into the overall capital efficiency of a business. The kind of my favorite way to look at this is ultimately what is the cumulative EBITDA or the cumulative burn that a business has generated over time versus the annualized gross profit that it currently is operating at. In this case, we can see that a business to date has burned $1.73 million to get to $2 million of annualized gross profit. Or in other words, it takes the business just under $1 million for just under $1 for every $1 of annualized gross profit that it is growing. And I can see that this has stayed relatively stable with a relatively kind of predictable up and to the right trend line here. So there hasn't been too much change about this over time. But if I want to look at the first derivative of this on a quarterly basis, I will look at this quarterly capital efficiency metric, where I basically look at how much has a business burned in a given month and how much has it grown in terms of annualized gross profit in that same quarter. And comparing this, how is this trending on a quarter-to-quarter basis over time? And you can see how overall this business is basically trending to become increasingly capital efficient, where in the past it would grow 50 cents for every dollar that it burned. And in the most recent quarter actually grew $1.23 for every dollar that it did burn. So it's becoming more capital efficient over time. Then lastly, if I have segments, like I do in this case, I have the AI generated segments based on how much our customers spending in their first month with the business. I can further double down on some of these trends that I'm identifying above to kind of explain why certain things are behaving certain ways, or even identify how are different customer segments retaining against each other, what customer segments are becoming more prevalent with the business over time, and how is that potentially impacting all the metrics above. This is a quick rundown of how I like to evaluate the performance of an early stage business leveraging Deepdive.